The stock market can be a scary place. It's especially daunting when you see headlines screaming about the S&P 500 hitting all-time highs. Your gut might tell you to run for the hills. After all, what goes up must come down, right? Well, not necessarily. Not when it comes to the stock market over the long term. It's natural to fear investing at market peaks. Many people worry about buying high and then watching their investments plummet. They imagine a sudden crash, wiping out their hard-earned money. This fear often leads them to hesitate, to wait for a dip, a correction, a sign that it's safe to jump in. But here's the thing about the stock market. It's driven by growth and optimism. Over time, the overall trend has been upward. Companies innovate, economies expand, and the stock market reflects this positive trajectory. While there will always be ups and downs, the long-term direction has historically been one of growth. So the question remains, should you let fear dictate your investment decisions? Or should you look beyond the headlines and consider the bigger picture? The answer, as with most things in personal finance, lies in understanding the risks and rewards and making informed choices that align with your financial goals. The stock market has a funny way of defying expectations. Just when you think it has reached its peak, it surprises you by climbing even higher. One of the most counterintuitive truths is that new highs often pave the way for even higher highs. This phenomenon can be perplexing to many. This might seem illogical at first glance. After all, how can something that has already reached its peak continue to rise? Why would the market, after reaching a peak, continue to climb? The answer is not as straightforward as it seems. The answer lies in the dynamics of investor behavior and the underlying forces driving economic growth. Investors are always looking ahead, anticipating future opportunities. When the market reaches a new high, it's a reflection of confidence in the future. This confidence is often based on positive economic indicators and strong corporate earnings. Investors see potential for continued growth and are willing to pay higher prices for stocks. This optimism can create a self-fulfilling prophecy. This in turn can fuel further growth as companies use the influx of capital to expand, innovate, and create more value. The cycle of growth and investment continues. Historical data supports this trend. Time and again, markets have shown resilience and the ability to reach new heights. Numerous studies have shown that investing at market peaks, while seemingly risky, has often yielded positive returns over the long term. This is a testament to the market's enduring strength. Of course, past performance is not indicative of future results, but it does provide valuable insights into how the market has behaved over time. It's a useful guide for making informed decisions. It's also important to remember that the stock market is forward-looking. It is always trying to price in future events and trends. It doesn't dwell on the past. Instead, it focuses on what lies ahead and the potential for future growth. Instead, it anticipates future earnings, economic indicators, and global trends. This forward-thinking approach is what drives the market to new highs. So, while a new high might seem like a reason to hit the brakes, it could actually be a sign of continued momentum and a signal to stay invested. The journey of the stock market is one of constant evolution and growth. The year 2024 has been a testament to the stock market's ability to defy expectations. The S&P 500, a widely recognized benchmark for the U.S. stock market, has shattered records, reaching new all-time highs an astonishing 38 times throughout the year. This remarkable performance has left many investors both exhilarated and bewildered. How can the market keep climbing in the face of global uncertainties, geopolitical tensions, and economic challenges? The answer, as always, is complex and multifaceted. Factors such as technological advancements, low interest rates, and corporate earnings growth have all played a role in propelling the market forward. However, the most significant factor might be the simplest one: investor sentiment. Despite the constant barrage of negative news and predictions of an impending crash, investors have remained largely optimistic. They continue to pour money into the stock market, driving prices higher and fueling the upward trend. This is not to say that there haven't been bumps along the way. There have been periods of volatility, brief dips, and moments of uncertainty. But each time the market has rebounded, proving its resilience and reinforcing the belief that, over the long term, the trend is your friend. Section 4. The pitfalls of timing the market. One of the most common mistakes investors make is trying to time the market. They believe they can predict the perfect moments to buy and sell stocks, aiming to maximize their returns. They wait for a dip, a correction, a sign that it's safe to buy, only to miss out on potential gains. This hesitation can lead to missed opportunities and regret. The truth is, timing the market is incredibly difficult, even for seasoned professionals. These experts spend countless hours analyzing data and trends, yet they still struggle to get it right consistently. It requires predicting the unpredictable, anticipating the unexpected, and often a healthy dose of luck. No one can foresee every market-moving event or economic shift. While it might seem logical to buy low and sell high, the reality is that market movements are notoriously difficult to predict. What seems like a clear trend can change in an instant. What seems like a peak could be followed by an even higher peak. The market can continue to rise beyond expectations, leaving those who sold too early feeling regretful. Conversely, what appears to be a dip could be the beginning of a prolonged downturn. Investors who buy too soon may find themselves facing further losses. The problem with waiting for a market dip is that you never know when it will happen, how long it will last, or how far the market will fall. This uncertainty can paralyze investors, causing them to miss out on potential gains. You could find yourself on the sidelines watching as the market continues to climb, only to buy in after it's already recovered. This often results in buying high and selling low, the exact opposite of the intended strategy. Moreover, even if you manage to time the market perfectly, there's no guarantee that you'll sell at the right time. The market's volatility can make it challenging to execute trades at the optimal moments. Fear and greed can cloud judgment, leading investors to sell too early out of fear or hold on too long out of greed. These emotions can significantly impact decision-making and overall investment performance. The emotional roller coaster of trying to time the market can be detrimental to your financial well-being and your investment returns. It's often better to adopt a long-term investment strategy, focusing on consistent growth rather than short-term gains. Section 5. Riding the wave with index funds. A simple approach to investing. For most investors, especially those who are new to the stock market, a simpler and often more effective approach is to invest in index funds. These funds offer a way to gain exposure to a wide range of stocks without the need to pick individual winners. Index funds are like baskets of stocks that track a specific market index, such as the S&P 500. This means that instead of buying shares in individual companies, you buy shares in a fund that holds a diversified portfolio of stocks. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of ownership in all 500 companies in the index. This diversification helps to spread risk and can lead to more stable returns over time. One of the most popular and well-regarded S&P 500 index funds is the Vanguard S&P 500 ETF, also known as VOO. This fund is favored by many investors for its low cost and broad market exposure. This fund offers broad market exposure, low fees, and a proven track record of delivering competitive returns. Over the long term, it has consistently outperformed many actively managed funds. By investing in VOO, you're not betting on the success of any single company, but rather on the overall growth of the U.S. economy. This approach can provide a more stable and predictable investment experience. Index funds like VOO are designed to be long-term investments. They are ideal for investors who are looking to build wealth gradually over time without the stress of frequent trading. They're not meant to be traded frequently or timed to perfection. Instead, the goal is to invest consistently and let the market's natural growth work in your favor. Instead, you simply invest consistently over time, regardless of market fluctuations, and let the power of compounding work its magic. Compounding allows your investment returns to generate their own returns, leading to exponential growth over the long term. The beauty of index funds is their simplicity and diversification. They provide exposure to a wide range of companies and industries, reducing the risk associated with investing in individual stocks. They provide a hassle-free way to participate in the stock market without having to pick individual stocks or worry about timing the market. This makes them an excellent choice for both novice and experienced investors. By investing in a broad market index fund, you're essentially betting on the American economy's long-term growth potential. This strategy aligns your investments with the overall progress and innovation of the economy, providing a solid foundation for future financial growth. Section 6. Embracing market peaks as stepping stones to growth. Instead of fearing market peaks, consider embracing them as stepping stones to long-term growth. Remember, the stock market is forward-looking. New highs are often a reflection of optimism about the future, a belief that companies will continue to innovate, economies will expand, and profits will rise. While it's natural to feel apprehensive about investing when the market is at an all-time high, historical data suggests that these periods of peak performance have often been followed by further growth. Of course, past performance is no guarantee of future results, and there will always be risks associated with investing in the stock market. However, by adopting a long-term perspective, diversifying your investments, and staying disciplined with your investment strategy, you can mitigate these risks and position yourself to benefit from the upward trend of the market. Remember, time in the market is often more important than timing the market. Instead of trying to predict the unpredictable, focus on what you can control: your savings rate, your investment choices, and your emotional response to market fluctuations. By staying focused on your long-term financial goals and tuning out the noise of short-term market swings, you can navigate the ups and downs of the stock market with confidence and achieve your financial aspirations. Remember, time in the market is often more important than timing the market. Instead of trying to predict the unpredictable, focus on what you can control: your savings rate, your investment choices, and your emotional response to market fluctuations. By staying focused on your long-term financial goals and tuning out the noise of short-term market swings, you can navigate the ups and downs of the stock market with confidence and achieve your financial aspirations.